Now, now we are going with the third chapter explanation. I told you accounting principles. So in that account, before going to the accounting principle, I wanted you to be little clear concept of your capital assets, liabilities. Now we are okay with that. Now what is your principle of, what is your principle of accounting? So you have concept, assumption, principle, convention. So these are the terms we have. What is your concept is an idea, you know. You build an idea, how to take about, how to implement it, how to bring it out, like that the concept. So ideas are converted to teach how the written rules has to be followed in principle, or it is a set of rules which are define the way accounts should be prepared are known as principles. Okay, that is your ideas. It is only that development, it is your ideas which you are framing it. Principle teach how the written rules has to be implemented, how the principle should move about with the rules and procedures. So principle are known as general accepted accounting principles. We had before IFRS would come, before AS, like Indus AS accounting standard would come. Before that we had general accepted accounting principle. What is that general accepted accounting principle? They widely accept rules, accounting standard, AS, procedure followed for presenting financial information. They were being established by Financial Accounting Standard Board. Financial Accounting Standard Board they were established. So they define, it is only the that is general accepted accounting principles are common set of principles, common set of principles, standard and procedure. So they are the common set of. Now we are advanced, no more we have accounting, general accounting, this one like accepted accounting. We are so advanced now. IFRS, International Financial Reporting Standards we are using. Then we have that accounting standards are being changed to Indus, INDS, Indus. So many series are being done as per the advance. And then we have formed a company, the company account are formed by 2013. Many changes have been done now. So now common set of rules. See, uses of this word, comparison of financial statement for purpose of investing by the investor, revenue recognition was taken into consideration, classification of balance sheet. So what are the classification of financial statement, how the financial statement are categorized? It is first statement of profit and loss account, then a balance sheet which gives the position as on that day. Then we prepare cash flow statement for that, and then equities, change in equities. So all four put together will make your financial statement. Okay, financial statement. Yes, classification of balance sheet, item value to treat accounting standard as per the standards we treat. So inventory is one standard. Fixed assets are in, now fixed assets are no more we are quoting, but since it is a base we are still telling you all the assets and all. It is property, like property, plant and equipment we are telling now, which are tangible. Intangible are your goodwill, patent, copyright and all those things are there. Fine. So this is what we have to just know this. Now characteristics they are saying for this, they are uniform set of rules framed to ensure uniformity. They are man-made, we had done that, man-made, and derived from the experiments. As when we were preparing statement, profit and loss, balance sheet, that with the experiment we were trying to, like man-made, like that we were doing. They are not rigid static, like they are not so rigid, we can change as per the passage of time they were to change. The concept, assumption, accounting principles are going concern, accrual basis, conservatism. So separate entity concept. So here this concept altogether one only will take up. We have so many, about 14 concepts are there. We will just see into this. Before this, yes. Now I have told items value to asset accounting. So principles I teach how the returns rule. Convention was modification of principles. That is new development to upgrade it. So upgrading was done. So that we will see in the various concepts. Okay. That's what I wanted to tell you. Now yes, now separate entity. What is your separate entity concept they say? Like owners are separate, owners are looked into, though owners bring the fund, though owners are bring the common stock, equity or a capital they contribute towards running the firm, start of the business. But here owners are looked as individual people and your entity is looked separately. So Tata, for example, we can take Ratan Tata Group. So Ratan person is individual, as an individual, his is an entity separate, individual. In individual books of accounts, his name may come. Tata's group will come in the main business trading. Okay, that is what we had. Owner's personal books it will come and business transactions are recorded in your Tata groups. Okay, that is what we had to do this. Now going concern, we'll see what is this. Business always goes on. See, business always keep going and business is always continue. People may come, people may go. People may come, people may go. There is no stoppage for your concern. So your operation of business is going on. Either continue, foreseeable means in future. So it is assumed that the enterprise had neither the intention nor the need to liquidate. So there is no, like some people are going means it doesn't mean that, oh, we are liquidating our company, we are liquidating our firm and all. No, we will not do that. It is a foreseeable future, means it is keep going on. Like, okay. Financial statement normally prepared on the assumption that an enterprise is always in going concern. Fine. Now next is your money measurement concept. As per this concept, transaction which are measured in terms of monetary benefit, cash should come. Purchase, sale, payment of salary, monetary term. No monetary. Non-monetaries are what? When you have appointed a manager, you are paying a salary to him. Salary is that. That manager is not non-monetary he'll become. He is not a manager is not so important for us. What the payment is made, that is taken into consideration. However, they are important because their effect is not measurable in terms of manager I told. Though he may be an efficient manager, he is a non-monetary. But though he is the one who is bringing the final goal of the company, goal of the organization, but he is a non-monetary. Okay, that is what we have to money measurement. Okay. Now money concept, transaction, even if they are affect the result of the business, materially is not recorded if they are not convertible in monetary term. That is, employees are the asset of the organization. I told you, example of manager or employee. They are the asset of the company, but they are not term possible to include in the books of accounts of the enterprise. Correct? What we are paying to them, that will be recorded, but though they are very efficient, they are the asset of the company or the organization, but they are not brought into books of accounts. Now next is matching concept, revenue expenses. Expenses of that period match with expenses of that period. For example, all expenses match with the revenue of the period should only be taken into consideration. Consideration spelling will just change. CONSIDIRATION, consideration. Okay, that is consideration is what now? Supposing you have brought a furniture's worth rupees, 7 lakhs rupees you have brought, 7 lakhs. Now recognized value was only 5 lakhs rupees. 2 lakhs, that is 2 lakhs are staying in your stock. So what is the worth? Only that 5 lakhs what you have realized that amount, that only has to be recorded. The 2 lakhs which is shown in the stock, Inventory will not be recorded. That is how revenue of that period. During that period, what you have brought, what you have recognized, that much only you record. What is still in the stock, we have not realized out of that. We have not sold that. So that will not come into accounting. Yes? No. Accounting period concept. It is accounting period. Your account, we have standard accounting period. Financial year 1st April till 31st March. One financial year of 12 months, we are going to record our transaction. Beyond that, if you record, it will not be, it will be like a prepaid. Or we have not, 1 month we have taken short payment, we have not done, it will be an outstanding. That all are your adjustment entry. Account in your journal proper, we are going to put that, we will see. Generally taken for 1 year, every time after the completion of the period, the performance and financial position of the business are determined on 1st of April till 31st March. Whatever is there, that only with the help of that, we'll prepare a trial balance. We have seen classification, summarizing and all those. We'll prepare a trial balance, we'll prepare a statement of profit and loss account and a balance sheet. Anything which you have yet to be paid, it will be taken an outstanding. Anything provision has to be made, it will be made an entry with a proper journal. So this is what we are going to take into consideration. Fine. Object evidence concept. What is the term objective refers to being free from bias, okay, or free from subjectivity. Accounting measurement are to be unbiased and variably independently for that purpose. All accounting transactions should be evidence and supported by document such as bills. This is bills, bills, invoices, receipt, cash memo, etc. Only when you pass one voucher for expenses and make a receipt, then those cash memos, then only will read that. Some object is there, objective must be there, then that will be recorded. Okay, bills it is. Now historical cost concept. Business entity is essence in an exchange of money. Okay. The price paid or agreed to be paid in case of a credit transaction at the time of purchase is called a cost concept. So what is your cost concept? Machine purchase for 80,000, market value is 1 lakh. Share in the books is only 80,000, not the market value. Very, very important this is. So what is the cost concept or historical cost concept says? What you have bought the machinery worth 80,000, let after 10 years also in the books of accounts it will be 80 only. Your building, that is what the difference what when you are selling it, no, we will try to take in capital gain, in income tax we will do that. Or the gain, I just told you, over and above the profits what you are getting against the sale of assets and your machineries, whatever it is. So investment and all. So this 80,000, what cost is there? Today I brought the machinery for 80,000. That same, for example, 80,000 I brought, same will continue till then. Or I bought a building for 80,000, same that 80,000 at cost only I will show in my books of account. After 10 years if I open and see, my cost is still 80,000 only. Provided if machinery is there, it will get depreciated. Every year the depreciation is provided. So it will be there, we have to compare written down value with the sale proceed and all. So that is what the cost concept is there. Clear? Yes. Not the market value. So next is revenue recognition, realization. The concept said that any change in the value of asset is to be recorded only when the business realizes it. I've shown you, I've told you there also in your money concept like. So unrealized profit and loss is not recorded in books of account. Anything you have unrealized, something is unrealized out of anything, some sale you have done, what you have received only you record it. Otherwise don't record that. Note the going concern, cost concept, realization concept, given the valuation which gives the value criteria. Now main important is your dual aspect concept. One debit and credit. Later in next chapter, 4th chapter, I will start with the main thing about your single entry, double entry system and all. We will do that. Double accounting, single accounting and all. I'll tell you the clarity of both the accounts. So every transaction has two effects. In case of double entry system, one debit and a credit. See, whole of your big businesses we are doing, banks, people are functioning, preparing financial statement only on the base of one debit and one credit. Your whole account, statement of profit and loss account you're preparing, balance sheet you're preparing, everything on what? Only two rules. One, you have to debit what comes in, credit what goes out. I will teach you when I take up the types of accounts. Okay, this is your debit and credit. Two aspects have to be taken into consideration. Full disclosure concept. Accounting statements state full and completely all the significant information based on this decision can be taken by various interested partners. That is stationary items. Full, top level, middle level, lower level. All the stationary item, no, full disclosure you give. So stationary item, full disclosure means pencils, pen, all that separate you have to give the full disclosure. Stationary means not only your books are there in that, you have notebooks, you have pencils, you have pen, you have other things, eraser, all that full disclosure you give. That is the in full disclosure. When I come to materiality, then I'll tell you something, okay. So now conventions are there now. So that is later, yeah, we will do. When materiality I'll come, I'll tell you. There you don't require full value, you have to materially disclose that, full value. Convention concept is consistency concept. There should be no frequent changes in accounting policies. Any change, it should be disclosed. Stock valuation always, that is known as consistency. Consistency, every time stock is being valued in first in, first out method, last in, first out method, average stock method, like that. Once you are changing it, it should be immediately brought into books of accounts, brought to the notice. So whether to change, suddenly you cannot do. That is what your stock valuation. An enterprise can change the policies in following circumstances you can change by compliance with the provision of law. The law says that you have to change, then you change it. So only in that circumstances. Then brings books of accounts in accordance with issued accounting standard. So you have to bring the books into as per the accounting standard. That time you can go happily. Consistency change you can do that. Or when under change circumstances felt that new method will be reflect more true and fair view of financial. So in financial statement, if you make a change of your valuation of inventory or stock, then as per the law issued, compliance of the law should be there. Then you can go ahead. Now see materiality concept. Full disclosure. All the items showing significant economic effect on the basis of the enterprise should be disclosed in financial statement, and any insignificant item which will not only increase the work of the accountant but will not be relevant to the user need should not be disclosed in financial statement. Stationery purchased by enterprise only bulk through not used fully in the accounting year, purchase still shown as an expenses of that year because of the materiality concept. So there full disclosure. Your materiality, what stationery you brought, to that extent you show the amount. Don't bifurcate, full disclosure you don't give. So bifurcate that, don't bifurcate only, for example stationery where materiality disclose, you can do that. Materiality concept, continuation this is. Materiality concept, subject to terms, it is not on the judgment. Subject to terms, it is not on the judgment, common sense and discretion of the accountant, that which are not exception to full disclosure principles. So the accountant should be smart enough. What materiality he has to disclose, only that he has to put into books of accounts. That is what the rule it is for that. Next one is conservatism, prudence concept. Yeah, conservatism, prudence concept is only present profit gain should be recorded, no future gain profit, but anticipated of future losses should be recorded. What they say here, now when you are doing something, you are getting a profit, in future you are getting it. That cannot be brought into books of account. Any losses you are incurring in the future, that has to be brought. That is your prudence. So gain what you are getting in the future, that has not to be recorded. But whatever the losses you are going to incur, that has to be brought into consideration. For example, anticipated, that is, wait, I have told, yeah, only present future losses should be recorded. Over prudence concept, only present profit gain should be recorded, no future gain profit should be, if you are planning the future profit, what you are expected in the future, what you are getting, that should not be brought into books of account. But anticipated, any future losses, that has to be recorded. That is your conservatism. So clear, all the concepts are clear. Today, this principle, first chapter is over, second, all the basic terms are over, third chapter of principle, all this concept and conventions are over with you. Then we will start fourth chapter with your first accounting equations are there. So in your accounting equations, before going to accounting equation, I will try to take types of accounts, the different types of account, how you classify into three categories. First, previously we would do nominal account, real account and personal account we do. Now from few years we have stopped that. We will tell expenses and losses. We classify the nominal as expenses and losses we do. And then we have assets separately, liabilities separately and capital and drawing, that are separately. So that you will be so familiarizing what are your expenses, losses, what are your gain and profits, and what are your assets, what are your liabilities, what are your capital, like that you will. Once you know these differences, then what will happen for you, it is very easy to make your accounting equations. So tomorrow we will take that. Okay.